All right, so there are many ways to build wealth in real estate. Almost everybody on this channel is interested in doing so in some way. But one of the best and most underused methods is through a 1031 exchange. A 1031 exchange allows you to defer the capital gains taxes on the sale of a property as long as you reinvest the proceeds into another property within a certain time frame. Now, this can be an extremely powerful tool for building wealth over time, and it's something that every real estate investor should know about. In today's video, we'll discuss everything you need to know about 1031 exchanges so you can use them to maximize your profits in real estate. Let's dive right in. Now, a 1031 exchange is a transaction that lets you exchange one real estate investment property for another while deferring capital gains taxes. IRS regulations restrict the use of an exchange to like-kind properties only, and they prohibit it from being used for vacation properties. And don't worry, by vacation properties, I don't mean vacation rental properties, but there's going to be more on that later in the video. A 1031 exchange, also known as a like-kind or a starker exchange, is in general a trading of one investment property for another. The majority of swaps are taxable as sales, but if yours complies with 1031 regulations, you may only have a small amount of tax owed at the time of the exchange. In essence, you're permitted to alter the structure of your investment without, at least in the eyes of the IRS, cashing it in or realizing a capital gain. Now, this enables your investment to grow tax deferred going forward. The number of times you can perform a 1031 exchange is unrestricted, and gains from one investment property can be carried over to additional properties and so forth. Even though you might make money on each swap, you don't pay taxes on them until you sell the swap for cash several years later, perhaps. If everything goes according to plan, you'll only have to pay one tax at the long-term capital gains rate, which is now 15% or 20% depending on income, and 0% for some lower income taxpayers as of 2022. Now, the 1031 provision is for investment and business property, while under some circumstances, the regulations may also apply to a previous primary dwelling. It is important to note that both properties must be located in the United States to qualify for a 1031 exchange. Most transactions only need to be of like kind to qualify. Interestingly enough, you can actually trade a ranch for a strip mall or an apartment building for undeveloped property. So don't get too wrapped up in the verbiage of like kind. One of the best ways we are currently utilizing 1031 exchanges is in converting long-term buy and hold properties into new selective strategic short-term rental properties. One example of that would be, let's take for instance a long-term rental property that I currently hold in Colorado. That property is valued at very similar amount to another property that I have in the same state of Colorado. One is a long-term rental and the other is a short-term rental. The long-term rental generates $3,675 per month in rental income with a net cash flow position of somewhere around $1,000 a month, a little less than. Whereas a short-term rental in Colorado, again with a very similar value, is generating closer to $90,000 annually in rental income, or around the $7,500 per month average, and the net cash flow position is sitting at roughly $4,000 per month. So we're generating 4 times the net cash flow position with roughly the same value. Now, while real estate isn't looking so hot for some in the country in the foreseeable future, there are certainly pockets where short-term rentals are absolutely red hot right now. Now, we recently did a series of videos on the Orlando market. Make sure you're checking that out in the description below, or click the link above here at the top of the screen. The cash flow that we're seeing on these properties in some cases is quite incredible. And the 1031 exchanges are a great way to up-level an investment portfolio. Now let's look at some important 1031 exchange timelines and rules. These are very important, folks. Traditionally, an exchange involves 2 people swapping one piece of property for another. The chances of finding someone who wants the identical property that you have and has the precise property that you want are extremely slim, probably more like none. Now, because of this, delayed 3-party or starker exchanges account for the majority of transactions. In case you're wondering, starker exchanges are aptly named for the first tax case that allowed them. In a delayed exchange, you are required to have a qualified intermediary or middleman who retains the money after you sell your property and then utilizes it to buy the replacement property for you. This 3-party transaction is considered a swap. In a delayed trade, you must adhere to two crucial timeline criteria, the 45-day rule and the 180-day rule. Now, the 45-day rule is concerned with choosing a replacement property. Once the sale of your property occurs, the intermediary will receive the cash. You can't receive the cash or it will spoil the 1031 treatment. Additionally, you must identify the replacement property in writing to the intermediary, it's hard to say, within 45 days of the sale of your property, along with the replacement property that you do wish to buy. According to the IRS, you are permitted to identify 3 properties as long as one of them is eventually closed. And if they pass specific valuation standards, you may even choose more than 3 as well. Now, in a delayed exchange, the 180-day rule deals with the closing. Within 180 days of selling the previous property, you must close on the new one. The 2 timeframes overlap, so you begin keeping track of them as soon as your property is sold and the deal is final. For instance, you would only have 135 days to close on a new property if you choose one exactly 45 days later. It's also possible to buy the replacement property before selling the old one and still qualify for a 1031 exchange. And in this case, the same 45 and 180-day timeline windows will apply. Now, to be eligible, you've got to transfer the new property to an exchange accommodation title holder, choose a property to exchange within 45 days, and finalize the exchange within 180 days of purchasing the replacement property. After the intermediary purchases the new property, you might have cash that's left over. And if so, the intermediary will provide you the money at the conclusion of the 180-day period. And this money, referred to as what they call the boot, will be taxed as a portion of the proceeds from the sale of your asset, typically as a capital gain. Now, one of the most common ways that people get into trouble with 1031 exchanges is failing to consider loans. Please keep in mind that you must consider mortgage loans or other debt on the property that you relinquish, as well as any debt on the replacement property. If you don't receive cash back, but your liability goes down, then that also will be treated as income to you, just like cash. Suppose you had a mortgage of $1 million on the old property, but your mortgage on the new property that you receive in exchange is only $900,000. In that case, you have a $100,000 gain that is also classified as the boot and will therefore be taxed. Now, as promised earlier on in the video, let's take a look at 1031 exchanges for vacation homes. It's possible that you've heard stories of taxpayers who exploited the 1031 provision to exchange one vacation home for another, possibly a home where they plan to retire, and Section 1031 delayed any gain recognition. Later, they resided in the new home as their primary residence and intended to utilize the $500,000 of capital gain exclusion in the future. Now, as long as you've lived there for 2 out of the last 5 years, this enables you to sell your primary house, and together with your spouse, you can save $500,000 in capital gains. Congress closed that loophole in 2004. That said, taxpayers can still turn vacation homes into rental properties and do 1031 exchanges. For instance, you might decide to quit utilizing your beach house, rent it out for 6, maybe 12 months, and then swap it out for another piece of real estate. The house has likely been turned into an investment property if you find a tenant and you handle yourself professionally, so your 1031 exchange should go smoothly. According to the IRS, renting out the vacation home without any tenants would make it ineligible for a 1031 exchange. All right, now that we've covered the basics that you need to know about 1031 exchanges, I'm going to wrap the video up by detailing how to report 1031 exchanges to the IRS. Again, be sure to speak with a tax professional when you're doing this. I am not a tax professional. I'm just giving you some direction here. The form you will need to use is Form 8824. And you'll need to actually include that with your tax return in the year the exchange took place. You're going to need to fill out the form with information about the properties that you swapped, their descriptions, the dates they were discovered and transferred, any connections that you might have with the other persons you traded properties with, and the market price of the like-kind assets. You're also going to be required to disclose the adjusted basis of the property given up and any liabilities that you assumed or relinquished. Like everything that's IRS related, it is crucial to complete the form accurately and without making any mistakes, as you could face a significant tax bill and the penalties, of course, if the IRS determines that you haven't followed the regulations. Smart real estate investors can employ a 1031 exchange as a tax-deferred method of wealth accumulation. Be sure to consider it when making plans for your real estate portfolio, and of course, be sure to enlist professional help when doing so. Now, what did you think about today's video? I'm always curious about the subject matter. Do you like it when I create this type of content and deep dive videos? What topic would you like us to cover next? Please share your thoughts in the comments below, and don't forget to like, subscribe, and share the video with somebody that you think could use it. Until I see you on the next one, make it a great day today and keep on cash flowing. Take care.